Good day, folks, and welcome to today's Intermediate Accounting 1 session. I am Mark Medalla, and in this segment, we will be dealing with the topic cash and cash equivalents. Before I begin, I'd like to share with you all that this topic, for me, is definitely one of my favorite accounting topics under assets, as it is easily comprehensible and enjoyable to learn. Moreover, this topic has significant practical implications wherein you can use the concepts in recording not only the entity's cash and cash equivalents, but also yours. By the way, the related accounting standards for this topic are PAS 1, Presentation of the Financial Statements, PAS 7, Statement of Cash Flows, PAS 32, Financial Statements, Disclosure and Presentation, PFRS 7, Financial Instruments, Disclosures, and PFRS 9, Financial Instruments. Without further ado, let's get started. Cash. When we hear this word, we would mostly and typically associate it with money. And what is money, by the way? Money is the standard medium of exchange in business transactions, and it refers to the currency and coins which are in circulation and legal tender. Nevertheless, in the accounting parlance, cash is not only limited to the idea of money, as it has a special and broader meaning. Cash, in the field of accounting, includes money and any negotiable instrument that is payable in money and acceptable by the bank for deposit and immediate credit. To simplify that definition, cash basically includes money and its equivalent that is readily available for unrestricted use. Remember the phrase readily available for use, or another term for that would be unrestricted use. With its special and broader meaning, cash has types, namely cash on hand, cash in bank, cash fund, and other cash items. When we say cash on hand, it pertains to the undeposited cash collections and other cash items awaiting deposit. The main idea of cash on hand is that it is unrestricted in use and the cash itself is physically kept by the entity and not deposited in the bank. Cash in hand is typically held in a secure location, such as a cash register, petty cash drawer, or safe, depending on the scale of operations. This type of cash is often used for day-to-day transactions, making small purchases, providing change to customers, or covering immediate expenses without the need for electronic payment methods. It is with utmost importance to properly manage and account for cash on hand to ensure accurate financial records. This may involve regular reconciliations, maintaining a log of transactions, and implementing internal controls to safeguard the cash. Cash in bank refers to the cash items in bank that are unrestricted as to withdrawal through electronic transactions, checks, or other banking services. For businesses, cash in bank is a vital component of managing working capital and ensuring liquidity. It allows for the efficient processing of payments, payroll, and other financial obligations. Cash fund refers to a designated amount of cash that is set aside for specific purposes within an organization. It represents a pool of money that is readily available to cover immediate expenses or to fulfill specific needs. Cash funds are typically managed separately from other cash resources to ensure proper allocation and control. Cash funds can actually be a component of cash on hand and cash in bank. While cash in bank and cash on hand are separate categories, they can be part of a designated cash fund depending on the specific needs and practices of an organization. Overall, cash funds serve as a practical and controlled way for organizations to manage specific cash needs. By establishing and maintaining these funds, organizations can effectively allocate resources, streamline expense management, and ensure the availability of cash for designated purposes. It's important to note that the specific policies and practices regarding cash funds may vary between organizations, so it is essential to follow the guidelines and procedures set by your organization when managing and utilizing cash funds. We also have other cash items, which later on I will present some examples of which. Now let us delve to the examples of the cash items I mentioned earlier. For cash in hand, common examples of which are coins and currencies. This refers to the physical money in the form of coins and paper currency issued by a government or central bank, used as a medium of exchange for goods and services. To simply put, those are the coins and bills that we typically have on hand or in our wallets. We also have checks, which refers to those issued papers which have the equivalence of cash. Checks also have types, and these are cashier's check, which is a check issued by a financial institution, drawn from the institution's own funds, and signed by a cashier. Guarantees the payment as the bank itself assumes responsibility for the funds. It is often used for large transactions or when immediate payment is required. We also have personal check. It is a check issued by an individual from their personal bank account and is typically used for making payments to individuals or businesses. Next in line is the manager's check. Manager's check is a check issued by a financial institution on behalf of one of its managers or officers. It is commonly used for larger transactions or when a higher level of authority is required for the issuance of the check. Traveler's check. A traveler's check is a pre-printed check that can be used as a safe and convenient alternative to carrying large amounts of cash while traveling. And we have certified checks received from customers or other external parties. Another cash in hand item are bank drafts. Firstly, don't get perplexed as to why this is classified under cash in hand and not cash in bank, despite the term bank on its very name. So, a bank draft, also known as a banker's draft or cashier's order, is a check drawn by one bank on another bank, wherein it guarantees payment as the bank issuing the draft has already received the funds from the account holder. Lastly, we have money orders. These are prepaid payment instruments issued by financial institutions. They are typically used for transactions when the payee requires a guaranteed form of payment. Money orders are purchased for a specific amount and are considered a safe and widely accepted form of payment. For cash in bank, common examples of which are demand deposits. Demand deposits refer to bank accounts that allow the account holder to withdraw funds on demand without any specific maturity date or notice period. These accounts are commonly known as checking or current accounts. They provide convenient access to funds for daily transactions and typically do not earn significant interest. Demand deposits are considered highly liquid and are suitable for managing regular expenses and facilitating payments. We also have the savings deposits. Savings deposits are bank accounts designed to encourage saving and accrue interest over time. They offer a secure place to deposit and accumulate funds while providing some level of interest on the balance. In practice, savings accounts often have a certain restrictions on the number of withdrawals or transfers allowed per month to incentivize long-term savings behavior. These accounts are ideal for individuals or businesses looking to build an emergency fund, save for specific goals, or earn modest interest on their savings. For cash fund, common examples of which are petty cash fund. A petty cash fund, also known as an Imprest fund, is a small amount of cash set aside for making minor or miscellaneous disbursements in an organization. The fund is typically managed by a designated custodian who is responsible for issuing cash from the fund and maintaining proper documentation of expenditures. The petty cash fund is replenished periodically to maintain its original fixed amount. Next in line is the receiving fund. A receiving fund is a cash account used to collect and record incoming cash or payments received by an organization. It is often used in retail or service-oriented businesses where cash transactions occur frequently. The receiving fund helps ensure accurate and efficient tracking of cash receipts and provides a centralized location for managing and reconciling incoming cash. We also have the payroll fund. A payroll fund is a dedicated cash account used to cover salary and wage payments to employees. It is often set up to ensure that sufficient funds are available to meet payroll obligations on time. By separating payroll funds from other operating cash, organizations can better manage and control payroll expenses. Next is the change fund. A change fund is a cash account established to provide sufficient small denomination currency and coins for making change during cash transactions. It is commonly used in businesses that handle a significant volume of cash transactions, such as retail stores or restaurants. The change fund ensures that there is an adequate supply of coins and currency available to provide customers with accurate change. Dividend fund. A dividend fund is a cash account set up to accumulate funds for paying dividends to shareholders of a corporation. It is often required by law or corporate bylaws to separate dividend payments from other company funds. The dividend fund allows for proper management and tracking of dividend payments, ensuring shareholders receive their entitled distributions. Tax fund. A tax fund is a cash account used to set aside funds for anticipated tax liabilities. Businesses may allocate a portion of their cash reserves to a tax fund to ensure they have the necessary funds available to meet their tax obligations when they become due. The tax fund helps prevent cash flow issues and allows for timely payment of taxes. Another classified cash fund item is the travel fund. A travel fund is a cash account designated for covering travel related expenses incurred by employees. It is commonly used to manage and track expenses such as transportation, accommodation, meals, and other travel related costs. The travel fund helps organizations control and monitor travel expenses while providing a centralized source of funds for employee travel needs. Interest fund. An interest fund is a cash account used to accumulate interest earned on investments or bank deposits. It is separate from the organization's operational cash and serves as a designated account for tracking and allocating interest income. The interest fund helps ensure that interest earned is properly accounted for and can be used for specific purposes, such as reinvestment or distribution. We also have other types of Imprest bank account used in current operations. Apart from the aforementioned types of cash funds, there can be various other Imprest bank accounts established for specific operational needs. This may include funds for specific projects, research activities, emergency expenses, or any other operational purposes that require separate cash management and control. Now let us know what are the other cash items. First on the list are the undelivered checks drawn or payable to supplier. These checks that have these are the checks that have been issued by a company but have not yet been delivered to the intended recipient, typically a supplier. The checks represent an outstanding liability of the company until they are delivered and cashed by the supplier. Post-dated checks drawn or payable to supplier. Post-dated checks are checks that have a future date written on them, specifying when they can be presented for payment. From the entity's perspective, when the entity issued a post-dated check, technically, the supplier cannot encash the check until the official date the check is readily available for withdrawal. Hence, the cash in the post-dated check is still part of the asset of the issuing entity up until the day before the check can be encashed by the supplier. We also have the stale checks as payment. Stale checks are checks that have not been cashed or deposited with a certain time frame, usually 6 months or more. When a check becomes stale, it may no longer be accepted by banks for payment. Stale checks can arise when recipients fail to present them for payment in a timely manner. From the company's perspective, stale checks may need to be reissued or replaced to ensure proper payment to the intended recipient. Next in line is the checkbook balance. The checkbook balance refers to the amount of funds available in a company's checking account as recorded in the checkbook. It represents the cash balance that can be used for payments or withdrawals through check transactions. The checkbook balance is updated as checks are written and cleared, as well as deposits and other transactions affecting the account. Unrestricted deposits in foreign banks. These refer to cash or deposits held by a company in bank accounts located in foreign countries. These deposits are not subject to any significant restrictions or limitations on withdrawal or use, allowing the company to freely access and utilize the funds as needed. Lastly is the unrestricted compensating balance as to withdrawal. This one is only disclosed in the notes, even though technically it is part of cash. Now, let us know what are the exclusions from cash. First, we have the post-dated customer's check. Post-dated checks received from clients or customers are not classified as cash as they are not immediately available for use. They represent future receivables and need to be recorded as part of accounts receivable until the specified date arrives and the funds can be collected. Next, we have the postage stamps. Postage stamps are excluded from cash because they are considered deferred asset expenditures. They are tangible assets that have value but are not readily available into cash. They are typically used for future mailing needs and are recorded as a prepaid expense until they are consumed. Third, IOUs or advances to employees. IOUs or advances given to employees are not classified as cash, but rather as receivables. They represent amounts owed to the company by employees and are recorded as assets until they are repaid. Cash fund not used in current operations. A cash fund that is not used in current operations is, of course, classified under non-current asset. It is excluded from current assets because it is not readily available for use in day-to-day operations. Instead, it represents cash that is set aside for specific long-term purposes or future needs. Examples of these types of fund are depreciation fund, sinking fund, preference share redemption fund, contingency fund, insurance fund, and plant expansion fund. We also have the bank overdrafts. This represent a credit balance in a bank account and are classified as liabilities. They are excluded from cash balance or from cash because they represent an amount owed to the bank rather than funds available for use. Bank overdrafts are usually presented as a separate line item under current liabilities. However, there are special treatments for bank overdrafts. When the overdraft is repayable on demand and integral to the entity's cash management, it will be deducted from cash. Same also with the scenario wherein an entity's bank account contains an overdraft and the other bank account in the same has a positive balance. In this regard, the overdraft may be offset or deducted from the other bank account with a positive balance as long as the accounts are in the same bank. Deposits in escrow. Deposits held in escrow are classified as restricted cash or restricted assets. They are excluded from cash because they are legally restricted and can only be used for specific purposes or released upon the occurrence of certain conditions. Next on the list is the unused credit line. Unused credit lines are not classified as cash but are generally disclosed in the financial statements, specifically in the notes. They represent the borrowing capacity available to a company but are not considered cash until they are drawn upon. Deposits in the bank that went bankrupt. Deposits in a bank that went bankrupt are classified as receivables. However, their value is measured at net realizable value, which takes into account the estimated recovery amount based on the likelihood of the funds being returned. Lastly, restricted deposits in foreign banks. Similar to deposits in escrow, restricted deposits in foreign banks are excluded from cash and classified under receivables. They are restricted in their use and can only be accessed or utilized for specific purposes or within certain limitations. Lastly, restricted compensating balance as to withdrawal. Restricted compensating balance is classified as either a current or non-current asset, but not cash. It represents a minimum balance required to be maintained in a bank account as part of a borrowing or banking arrangement. The restriction on withdrawal means that the funds cannot be freely accessed or utilized for other purposes, making it separate from regular cash. At this point, let us now delve to cash equivalents. Cash equivalents refer to short-term, highly liquid investments that are easily convertible into cash and have a maturity period of 3 months or less from the date of acquisition. These investments are considered to have a high degree of safety and minimal risk of changes in value. The idea of cash equivalence is that regardless of its maturity date, as long as it is acquired 3 months or less before the maturity date, that may be qualified as cash equivalents under certain rules and conditions as per the accounting standards. To further elucidate, cash equivalents typically have the following characteristics: high liquidity. Cash equivalents are readily convertible into cash without significant loss of value. They can be quickly sold or redeemed for cash, allowing for immediate access to funds when needed. Short maturity period. Cash equivalents have a short-term maturity period of 3 months or less from the date of acquisition. This means that they will mature and become due for payment within a relatively short period, ensuring that the funds will be available in the near term. Minimal risk of value changes. Cash equivalents are considered low-risk investments with minimal fluctuations in value. They are typically invested in highly stable and secure financial instruments such as treasury bills, commercial paper, or money market funds. These investments provide a predictable return and are less susceptible to market volatility compared to other types of investments, such as stocks. Preservation of principal. Cash equivalents aim to preserve the principal amount invested. While they may earn a small return in the form of interest, the primary objective is to maintain the original value of the investment rather than generate significant capital gains. Examples of cash equivalents are the following. First, we have the treasury bills, notes, or bonds. These are short-term debt securities issued by the government and are considered highly secure investments with a fixed maturity date, typically ranging from a few days to 1 year. Treasury bills, notes, or bonds are easily tradable in the secondary market, making them highly liquid and suitable for use as cash equivalents. Second, money market instruments. Money market instruments include short-term debt securities such as treasury bills, commercial papers, repurchase agreements, and short-term government bonds. These instruments are highly liquid and have a maturity period of 1 year or less. Money market instruments are typically issued by governments, financial institutions, or corporations, and they offer a relatively low risk investment option with competitive interest rates. Third, commercial papers. Commercial papers are short-term promissory notes issued by corporations or financial institutions to meet their short-term financing needs. They have a maturity period of less than 1 year and are considered to be highly liquid and low-risk investments. Commercial papers are actively traded in the money market and can be easily converted into cash when needed. Fourth, 3-month time deposit. A 3-month time deposit, which is secured with a certificate of deposit, is a fixed term investment offered by banks. It has a maturity period of 3 months, during which the funds are locked in the deposit account and earn a specified interest rate. 3-month time deposits are considered highly liquid and can be converted into cash before maturity, although there may be penalties or restrictions for early withdrawal. Fifth, preference shares with specified redemption date. Preference shares with a specified redemption date are a type of equity investment that carries a fixed maturity date. These shares give the investor the right to receive a fixed dividend before common or ordinary shareholders, and provide a predetermined redemption price at a specific future date. The specified redemption date ensures that the investment can be converted into cash at the predetermined date, making it a cash equivalent. Lastly, we have the investment of excess cash. When a company has excess cash that is not immediately needed for operational purposes, it may invest the funds in short term, highly liquid investments. The purpose of investing excess cash is to generate some return while maintaining the liquidity and safety of the funds, making it a suitable cash equivalent. If the term is 3 months or less, such investments are classified under cash equivalents. If the term is more than 3 months but within 1 year, such investments are classified as short term or temporary investments and presented separately as current assets. If the term is more than 1 year, such investments are classified as non current or long term investments. However, such investments that become due within 1 year from the end of the reporting period are reclassified as current. Like cash, cash equivalents also have its exclusions, and these are number one, equity securities or equity investments. Equity securities, such as common stock or preferred stock, represent ownership interest in a company. Unlike cash equivalents, equity securities do not have fixed maturity dates. They represent long term investments in the ownership of a company rather than short term, highly liquid investments. Since equity securities are subject to market fluctuations and do not have a predetermined maturity, they are not classified as cash equivalents. Number two, treasury shares or reissued shares. Treasury shares refer to shares of a company's own stock that have been repurchased and are held by the company itself. These shares are not considered as cash equivalents because they represent the company's ownership of its own equity rather than a short term, highly liquid investment. Treasury shares can be reissued or retired at a later date based on the company's decision, but they do not have a maturity date or the characteristics of a cash equivalent. At this point, let us now know the measurement and valuation of cash and cash equivalents. Cash is measured at their face value, which is the nominal value stated in the currency or financial instrument. The face value represents the amount that the currency or instrument is worth in the local currency. If the cash is in a foreign currency, their valuation needs to consider the current exchange rate. The amount of cash and cash equivalents in foreign currency is converted into the local currency using the prevailing exchange rate at the reporting date. This ensures that the value of foreign currency holdings is properly reflected in the financial statements. In certain situations, the estimated realizable value of cash and cash equivalents may be less than the face value. This can occur when there are concerns about the recoverability of the full amount due to factors such as financial difficulties of a bank or financial institution where the cash is held. In such cases, the recoverable value is used instead of the face value to measure and value the cash and cash equivalents. The recoverable value represents the estimated amount that can be realized or recovered based on an assessment of the specific circumstances. It's important to note that when cash in bank or financial institutions are experiencing financial difficulty or in bankruptcy, they should be shown at their recoverable value. This means that the estimated realizable value, rather than the face value, should be used to measure and value the cash and cash equivalents in such situations. This adjustment ensures that the financial statements reflect a more realistic value of the cash and cash equivalents, considering the potential risk of impairment associated with the financial institution's financial condition. At this juncture, let us have our discussion for the accounting for cash shortage and overage. Cash shortage refers to a situation where the actual cash count is less than the recorded book balance. When a cash shortage occurs, certain pro forma entries are made to properly account for and address the discrepancy. And here are the following. To initially record the cash shortage, we debit the account title cash short or over to initially reflect the amount of cash shortage. And we credit the account title cash to initially reduce the recorded book balance by the amount of cash shortage. When it is officially confirmed that the cash custodian is responsible for the shortage, we debit the account idle, due or receivable from cashier to establish a receivable from the cash custodian who is responsible for the cash shortage. And the amount represents the value of the shortage that the custodian is required to repay. Then we credit the account title cash short or over to offset the initial record of the cash shortage. When there is a failure to properly disclose the root cause of the shortage, or if the investigation of the shortage is without merit, we debit the account title loss from cash shortage to recognize the loss incurred due to the cash shortage, and the amount represents the financial impact of the shortage on the organization. Then we credit the account title cash short or over to offset the initial record of the cash shortage. On the other hand, cash overage refers to a situation where the actual cash count exceeds the recorded book balance. When a cash overage occurs, specific pro forma entries are made to properly account for and address the excess amount of cash. And here are the following. To initially record the cash overage, we debit the account title cash to initially increase the recorded book balance by the amount of the cash overage. And we credit the account title cash short or over to initially reflect the amount of cash overage. When it is officially confirmed that the cash overage is found to be the cashier's money, we debit the account title cash short or over to reduce the initial record of the cash overage. Then we credit the account title payable to cashier to establish a payable to cashier who is the rightful owner of the excess cash, and the amount represents the value of the cash overage that needs to be returned to the cashier. When there is a failure to properly disclose the root cause of the overage, or if the investigation of the overage is without merit, we debit the account title cash short or over to offset the initial record of the cash overage. Then we credit the account title gain from cash overage to recognize the gain resulting from the cash overage, and the amount represents the financial benefit gained from the excess cash. Observe that we commonly use the account title cash short and over, whether we are accounting for a cash shortage or cash overage. This is due to the fact that the cash short or over account is only a temporary or suspense account. When financial statements are prepared, it should be appropriately adjusted. Let us move forward to accounting for petty cash fund. Petty cash fund refers to a small amount of cash that is set aside by a business or organization to cover minor and routine expenses, such as office supplies, postage, and small miscellaneous expenses. It is used to facilitate quick and convenient cash payments for small transactions. What constitutes a small amount is a matter of a company policy. For instance, an entity may provide for a policy that all disbursements amounting to 10,000 pesos or more should be made through checks, while disbursements below 10,000 pesos may be made through the petty cash fund. When accounting for a petty cash fund, an entity may use the Imprest fund system or the fluctuating fund system. Under the Imprest fund system, petty cash expenses are recorded upon replenishment. It requires all cash receipts to be deposited intact and all cash disbursements to be made through checks. The replenishment amount is equal to the total amount of petty cash disbursements. Here are the pro forma entries for the Imprest fund system. To establish the petty cash fund, or whenever there's an increase in the petty cash fund, we debit the account title petty cash fund to record the establishment of the petty cash fund or the increase in its balance. Then we credit the account title cash in bank to reflect the decrease in the cash balance due to the transfer of funds to the petty cash fund. Whenever there are disbursements or payment of expenses out of the petty cash fund, journal entries are not required as petty cash disbursements are recorded in a petty cash register, which serves as a log of all expenditures made from the petty cash fund. To replenish the petty cash fund, we debit various expense accounts to record the individual expenses incurred and reimbursed from the petty cash fund. Then we credit the account title cash in bank to reflect the increase in the cash balance due to the replenishment of petty cash fund. To record any adjustments for an unreplenished fund at reporting date, we debit various expense accounts to adjust for any unreplenished amount in the petty cash fund at the reporting date. Then we credit the account title petty cash fund to reduce the balance of the petty cash fund by the unreplenished amount. When the petty cash fund decreases, we debit the account title cash in bank to reflect the decrease in the cash balance to the transfer of funds. We debit, we debit cash in bank to reflect the decrease in cash balance due to the transfer of funds from the petty cash fund back to the bank. Then we credit the account title petty cash fund to reduce the balance of the petty cash fund. Under the fluctuating fund system, petty cash expenses are immediately recorded or expensed outright, and the replenishment amount can be greater than, or less than, or equal to the total petty cash disbursements. The pro forma entries for the fluctuating fund system are similar to those of the Imprest fund system with the following difference. Unlike the Imprest fund system's no journal entry record, whenever there are disbursements or payment of expenses out of the petty cash fund, we debit various expense accounts to record outright the expenses made out of the petty cash fund, and we credit the account title petty cash fund to record the decrease in the fund out of the disbursements. To replenish the petty cash fund, we debit the account title petty cash fund to reflect the decrease in the fund's balance due to the reimbursement of expenses, and we credit the account title cash in bank to reflect the increase in the cash balance due to the replenishment of petty cash fund. When there are adjustments for an unreplenished fund at reporting date, no journal entry or adjustments should be made as petty cash expenses are recorded outright, unlike the Imprest fund system. At this point, we're going to talk about the common unethical practices concerning cash balances. Unethical practices concerning cash balances can have serious implications for the integrity and accuracy of financial statements. Here are the common examples of unethical practices related to cash balances. First, we have lapping. This occurs when the collection of receivables from one customer or client is misappropriated and concealed by using funds from subsequent collections made by another customer. This practice aims to cover up the misappropriation and create the illusion of consistent cash inflows. For example, a dishonest employee may receive a payment from customer A but divert it for personal use. To cover up the theft, they may apply a payment receipt from customer B to customer A's account, concealing the initial misappropriation. Second, kidding. This involves manipulating cash balances to conceal a cash shortage by artificially inflating the reported cash balance. This is typically done through the fraudulent use of interbank transfers or by creating fictitious transactions. For instance, an individual might write a check from Bank A, deposit it in Bank B, and then withdraw the funds before the original check clears. By repeating this process between multiple accounts, they create the appearance of sufficient funds in each account, despite the actual shortage. Third, window dressing. This refers to the practice of manipulating financial statements to present a more favorable financial position that actually exists. In the context of cash balances, this can involve delaying the closure of books at the end of a reporting period and intentionally recording subsequent transactions in the current period. By recording additional sales, inflows, or reductions in expenses, the entity's financial performance or ratios can be artificially improved. This practice aims to create a positive impression for investors, creditors, or other stakeholders. That officially ends our intermediate accounting 1 session for cash and cash equivalents. Hopefully, you have learned something out of the discussion. Just some tips to foster your knowledge regarding this. You may answer some problems and theory items under cash and cash equivalents, and every now and then, we read the concepts for you to really retain your knowledge regarding this topic. You may also apply these tips in other topics, and if you have questions and or clarification regarding this topic, feel free to drop your questions and or clarification in the comments section. Again, I am Mark Medalla. See you in the next accounting session.